Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures wavering this morning as investors await key labor market data and a potential call between President Trump and China's Xi Jinping. The U.S. payrolls report for May expected to show slowing job growth and follows a weaker than expected ADP private payrolls print and a little bit of weakness in the jobless claims data. Any further weakness could bolster calls for the Fed to cut rates. Meantime, investors will also be searching for any progress on trade, with a call between Trump and Xi Jinping reportedly happening as soon as this morning, according to Chinese state media.
Plus, investors will closely be watching results from chip maker Broadcom. Those are out after the closing bell for the latest read into the AI trade. The company's soaring share price has catapulted the chip maker into the ranks of the world's most valuable companies, increasing pressure on the company's results tonight. More than half of the stock's $540 billion rally since April, and that low that has come in the past month, amid signs that heavy spending on artificial intelligence gear is poised to continue.
And stablecoin issuer Circle is set to go public today. The crypto company raising $1.1 billion in an upsized initial public offering that was priced above a market range, and a sign that stablecoin issuers are winning greater acceptance. The company now has a fully diluted valuation of $8.1 billion. The offering coming as the Senate is set to advance industry-backed stablecoin legislation, which would add more legitimacy to the company and to the industry.
Keeping close tabs on U.S. stock futures this morning, inside of 30 minutes until the start of trade. And taking a look at the Dow, the S&P 500, and the NASDAQ, we're seeing futures point higher right now. Additionally here, Chinese state media reporting that Xi Jinping and President Trump spoke over the phone early Thursday, a welcome sign of possible progress in trade talks between the two nations. Joining us now with what the latest talks could mean for the market and investors, we've got Stephanie Guild, Robinhood Markets Chief Investment Officer. Great to have you here with us this morning. You know, as you're continuing to track so much of the investor appetite to either try and place their long positions off of some of the lows in April and what this rally could further hold from here, what are you seeing in the data?
In terms of what customers are doing, or in terms of, so our customers, it's interesting, as we had the Liberation Day come and the market sold off, we saw our customers using ETFs as a way to get back and get invested, broad-based ETFs. And in fact, typically our notional trading, 20% of it is ETFs, but around that time it was around 40%. Since that time, however, more recently, customers are back to kind of the normal trading volume on ETFs and really focusing on single stocks. And that is where I think our customers spend more of their time. NVIDIA and Tesla continue to be like the most traded names along with Palantir, but they've actually been selling NVIDIA more recently. So I think they're just kind of focused, I think similar to the way I've been thinking about things, right? Have to kind of cut out a lot of the noise because there is going to be there's a tweet here, there's an announcement here, there's a phone call here. I think you have to cut out a lot of the noise and just say okay, when you turn down the volume when you're driving, right? And you do that to see better. You want to sort of think what is actually happening under the hood. Mm-hmm. And that's what I think our customers are doing too. We are focused on single names, and I think the benefit of this environment is that you have intra-stock correlations. Right. That have dropped quite a bit. During, pre-COVID times, they were actually pretty high. And that's why you sort of wanted to spend more time just owning long ETFs, right? And now I think that's actually changed quite a bit.
Yeah, Stephanie, it's a great overview of kind of the activity that you're seeing, and I'm curious about how that informs how you view some of the headlines we're even getting in as we are currently talking to you. One in particular coming to mind, that President Trump and Xi Jinping are having these phone talks currently, according to some reports. Market up ever so slightly, also in light of worse than expected jobless claims this morning, just a tick. So is this the market saying yay to any headline of trade talks, or are we post the era of moving so significantly off of every trade headline?
I think we're post the era. Like, the more this goes on, the more desensitized you come to every single bit of information.
Yeah.
I think there is definite hope in the market still, though, that there will be deals that come, and that's why I think I call it the whipsaw factor is high, which is why you can't just be like not participating, I think, in it. You just have to be balanced. Like, the way we've been thinking about it is have some dry powder, have some, ability to kind of weather some of the higher volatility, but stay in it for some of there's a chance that some cyclical growth names start to take off.
I mean, we're still within 200 points of the S&P 500 high at this juncture with no deals right now. I mean, okay, US, UK, if we want to count that.
Yeah.
But at the end of the day, for all of the talk that we're seeing emerge from both sides, and whether that is the US and China, whether that's the US and India, we're still waiting for the details of these deals to really figure out how investors can also trade on that. So what should investors be using as their checklist as we do see some of the details come out around these deals, if we do see them prior to the end of this truce period, which is up in just about a month here?
July 9th, the first one anyway.
Yes.
I think there's a couple of things. One is that whenever I hear, I think a good barometer has actually been listening to Treasury Percent. I think he's, when he went out on Face the Nation on Sunday, some of the things he said has already started, he talked about how the deficit is not going to be as big an issue and that the CBO was not taking into account, some of the tariff revenue. And then, I think it was yesterday, they said, actually, we're going to cut the deficit by $400 billion over the next 10 years. I mean, who knows what will happen over the next 10 years, but at least the plan is not to raise it. And that is good for interest rates, right? And interest rates do drive valuation. So I think he, to me, has been a good barometer because what he does say comes true. And I personally think there's going to be deals. So the way we started managing money, we have a product called Robinhood Strategies. And in it, we've actually been pretty diversified, where we have allocations to some international equities, because that's where I think, you have to have some of that diversification, not just thinking about the US in this global environment, because if there are deals, then those non-US investments are going to probably do well, and then you'll have some cyclical growth names do well here as well.
Can we double click on the cyclical growth names, and why do you think that is potentially a better investment than the likes of continuing to double down on an NVIDIA, for example?
I'm not saying don't do things like NVIDIA, but I think markets have gotten pretty well valued, right? I think, even with earnings estimates coming down, valuations are fair at best. If you look out to 2026, right, they're around 20 times. In the mid-cap space, for example, though, you've actually seen valuations come down because you've seen earnings estimates come down, but you've actually seen prices come down even more, and they haven't rallied back. And so that's why I say in the mid-cap space is maybe a place to play. And then you end up getting, kind of a mix of things that, of pro-cyclical things, right? And then things that are maybe a little more defensive versus I'm still not a fan of small caps, for example, because it's just still too focused on there. But I also think financials is a place to consider because I do think what everyone's forgotten about in the midst of tariffs is that there is this other side of the administration's policy, which is M&A and deregulation, and financials is probably a place that will benefit from that.
Just lastly, while we have you here, what is the appetite that you're seeing from Robinhood users right now in crypto? We're seeing Bitcoin seemingly stabilize above 100,000 right now, and $6,000 off of its all-time high at this juncture. What type of activity are you seeing there?
I mean, our customers like to actively trade it, so it's certainly they're not just trading in Bitcoin. We offer lots of different coins, but everyone they're pretty much holding on to their Bitcoin. We have seen a little more activity in the other areas, like Ethereum and Ripple and
is it core holding the cryptocurrency, or is it looking at ETFs that are baked around cryptocurrencies or Bitcoin specifically? How are they kind of using some of the new asset types, even from what you're saying, to get some exposure?
Yeah, I mean, the ETFs has become a place where people do invest, but I'd say the core, because you can buy crypto and you can do it pretty cheaply, that people are using it that way. We've also seen MicroStrategy as a play from our customer base as a
as the Bitcoin proxy.
As the Bitcoin proxy, yeah.
Stephanie, it's always great to have you. Thank you so much. Really great insights this morning. Appreciate it. Let's take a look at Apple here. It's down 19% year to date, the lowest performing member of the Magnificent Seven and trailing the S&P 500, which is now up for the year. Ahead of Apple's company Worldwide Developers Conference, Needham & Company cut its Apple rating from buy to hold and removed its $225 price target for the stock. We got the person behind that call, Laura Martin, Needham & Company Senior Media and Internet Analyst, joining us now. Really appreciate you making the time to break this down for us. Laura, what was the single biggest driver behind this call on Apple?
So I think we're focusing on two things. There's like an urgent problem for Apple and then an important problem for Apple. The urgent problem is it's really expensive today at 26 times next year's earnings, which is twice its normal multiple over the last 10 years and about a 25% premium to the S&P 500. So it's too expensive. Second, there are real risks to their fundamentals over the next 12 months, not only tariffs, but also like the Chinese demand, which used to be 19% of their total iPhone sales, went to 17% last year. We expect it to go to 15% of total sales this year. So there really is issues with the rising nationalism in China and Chinese consumers buying competitive products and not Apple products. Also, we have risk to fundamental services revenue because you may have seen that the Epic court decision, which allows all these apps to actually get direct payment and not pay the Apple 30% tithe on these app payments. So that actually threatens services revenue. Anyway, lots of fundamental risks coming from the outside world in the near term to their fundamental earnings per share risk in addition to just tariffs. And the important problem here that isn't as urgent, but it is really important, is competition. So what's happening is generative AI is opening up the possibility of replacing the smartphone with, if you think Meta and Google are right, glasses, like these Ray-Ban glasses that Meta's already sold 1 million units of, or more importantly, Johnny Ive, who was actually the designer behind every major Apple product on the market today. He was at Apple for 27 years. His company's been bought by Sam Altman's OpenAI, and they're talking about a new form factor that isn't a smartphone and it isn't glasses, but it's going to compete and replace, I think over the long term, replace the iPhone, because Johnny Ive, who invented the iPhone as a design hardware, said he doesn't like screens. He wants to move consumers away from screens, which would be lovely if you could have a conversation with a 15-year-old where they weren't looking at their screen. So I'm completely supportive. But all of this is a competitive threat to the largest iPhone maker, the largest smartphone maker in the world.
And so, Laura, within that, the strategy from at least during Tim Cook's tenure as CEO and the lead of Apple has been, we don't need to be the first mover necessarily, but we do need to assess to see what the market reception for some of these more innovative products looks like. If Sam and Johnny Ive are successful in that effort, to what extent would Apple be able to iterate on top of that new innovative technology and then try to put that into the ecosystem, even if it was a potential iPhone threat in the future?
Right. So great point. Couldn't they just fast follow? And I would make 2 points about that. One is the innovator's dilemma, which is the Clay Christensen work out of Harvard Business School, says that the incumbent fights to keep his dominant market share. So so far, Apple has not shown itself to be a fast follower. It's been a slow follower. And then secondly, whatever this new hardware platform is, whether it's maybe it won't work, but if it's glasses or it's the Johnny Ive, whatever he invents that he says he's going to launch midway next year, we'll have a generative AI backbone. It won't just be that the hardware is new with old tech. It will be a completely new generative AI backed ecosystem. It may not even be apps. If Johnny Ive is trying to move us away from screens, it's going to all be voice controlled, right? So then you're not going to have apps. You're going to need something else that isn't an app. So again, like mobile, remember the smartphone and Steve Jobs sort of redefined how we interact with the world through the web using a smartphone, really, right? Remember, we had BlackBerries. So this is as revolutionary as that, but I think it won't even have screens. So I think it's going to be really hard. Apple is really slow on generative AI, whereas Google with Android and a large language model will be a fast follower to whatever OpenAI and Johnny Ive invent.
Laura, I recognize that you've got a hold rating now, but I am curious, should investors listening to this conversation be considering selling their Apple shares?
we would move to the sidelines and use Apple as a source of cash to buy something else. Importantly, like why now? We have the Worldwide Developers Conference on Monday, and then we have the Apple hardware introduction in September. What we would say is we are anticipating nothing to generate an iPhone replacement cycle in the next 12 months. And if you don't have an iPhone replacement cycle, I think these shares don't work. I think what is required for Apple to outperform is an iPhone replacement cycle. And nothing that we see in the headlines and through our channel checks suggests that's going to happen. So why be an Apple? Move to the sidelines, put your cash somewhere else, something more exciting, and then come back to Apple when they're going to have a product that actually drives an iPhone replacement cycle, hopefully in September of 26, not 5.
Apple is certainly caught up within the political landscape as well, as we know that they've had the attention, really never lost the attention of President Trump, and in the 2.0 administration of President Trump, directly going at them via Truth Social a few weeks back. All those things considered, what is the likelihood that Apple would even move more of its manufacturing to the U.S., knowing that for its core product, the iPhone, that would skyrocket the potential price?
Yeah, 3 times. We think it would make the iPhone cost 3 times as much. And it takes years, not months, to move these manufacturing capabilities. So right now, Apple's moving its manufacturing capabilities to India from China, but to move it to the US, it would actually come after this administration had changed out. Like this president would no longer be in the White House, because that's how long it takes to move these manufacturing lines.
Laura, yours is one of the only notes that I actually print out every time we're about to have you on. Thanks so much for taking the time.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Morning Brief. Now time for some of today's trending tickers. We are watching Procter & Gamble, PVH, and Broadcom. First up, Procter & Gamble announcing plans to cut 7,000 jobs, or about 6% of its global workforce, over the next 2 years. The Tide maker also plans to trim its product portfolio, exiting some categories and divesting smaller brands in certain markets. You're seeing shares move lower by about 0.3% right now. And just a correction here as well, or additive, the company in reducing 7,000 roles, this is about 15% of their current non-manufacturing workforce, we should mention on top of this.
Yeah, and this is just the latest in a slew of headlines that have started to increase about company layoffs off the back of other layoffs that we've heard of from the likes of Microsoft, for example. But we did get to hear exclusively from the CEO of P&G, our very own executive editor, Brian Sozzi, speaking with the P&G CEO in April about the company's latest earnings results. Let's take a listen to what he had to say.
We need to find other solutions, and those would include, obviously, unrelated cost reductions. They would include potential pricing. So we're looking through all of those options as the tariff landscape hopefully develops some certainty and clarity.
And clearly going with the option in terms of that list of laying off workers. You can see the shares down about 0.3%. But next up, let's talk about PVH cutting its full year earnings outlook, reflecting an estimated net negative impact related to tariffs currently in place. This is the Calvin Klein owner topping first quarter results with revenue up 2% from a year earlier, but those shares really taking a hit here, down over 12%. Taking a look at some analyst commentary, BMO Capital Markets, Simeon Siegel, friend of the show here, he's got a market performer on the name saying the gross margin contraction reflected increased promos and an unfavorable channel mix, also higher freight management costs as well. So a little bit of a call out to some tariff policy impacting some of those costs. Evercore also talking about the forward guidance when it comes to EPS and the forecast cut being disappointing and indicating signs of share loss in the first quarter as well. Yeah,
first mention in a earnings filing that we've seen this year, I believe, of Bad Bunny. They mentioned that Calvin Klein saw one of its most impactful product launches in years with the Icon Cotton Stretch franchise, amplified by the viral Bad Bunny campaign. That aside, there's a lot of uncertainty right now. They mentioned this, Larson, the CEO, talking specifically as part of the commentary within this release, saying that looking ahead, we're focused on what we can control, stepping up their actions, trying to scale the impact of their stronger product, next level cut through campaigns, sharper marketplace execution. But this is the strength, at least, is banked on in the back half of the year. And of course, as we're just weeks away from the back half of this year, we're going to be watching closely to see how they ultimately hit some of these targets that they are putting forward. Right now, shares moving lower. Investors not too impressed. It's down by about 12.7% right now. Finally, let's talk about Broadcom here, set to report second quarter earnings after the closing bell. Analysts expecting a positive report after NVIDIA's results saw revenue up 69%. Broadcom, it climbed to new all-time highs this week as investors continue to cheer AI's momentum. Take a look at shares of Broadcom. They're up right now by about 0.9%.
Yeah, building on a 6-day winning streak ahead of these earnings results. If we take a look at options pricing, the market pricing in a move of about 6.5% in either direction off the back of this print. Also taking a look, shares are up 30% over the last month, as you can see here on your screen. And that, as you mentioned, Brad, is in part due to the bullishness surrounding the AI trade that we have seen, leading to huge gains for the likes of NVIDIA, of course, the name that you think of when it comes to AI, which had a $1 trillion run over the last 2 months.
Yeah, Broadcom saying, hold my beer.
Yeah, exactly.
We can be the name you think of.
Exactly, and options certainly pricing in a lift here. The company consistently having a move to the upside in its stock off the back of earnings, which we will be covering here at Yahoo Finance. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the Nintendo Switch 2 is officially out with lines across the US and the world as gamers head to their nearest retailer to pick up the new console. The first Nintendo Switch launched in 2017. It sold 152 million units. Nintendo expecting to sell 15 million units of the Switch 2 this year, despite potential headwinds from global trade tensions. Yahoo Finance tech editor Dan Howley joining us now with more. Dan, great to speak with you about this launch. Very exciting for the gamers out there. What are you anticipating in terms of the success of this launch for Nintendo?
Yeah, very exciting for the gamers, very excited for me. I got my Super Nintendo controller above my head there, dissected. But for the company itself, this is a huge launch. I mean, this happens once every 7 to 10 years. Nintendo last launched this in 2017. So this is a huge deal for them. The success of the Switch was virtually unprecedented for their home console brands. They're generally go between a ebb and flow kind of pattern when it comes to the success of those consoles. So we had the huge success of the Switch. Now we have to see if they can break that ebb and flow pattern for the Switch 2. And the ebb and flow pattern I'm referring to is, you go from the Super Nintendo to the Nintendo 64, the GameCube. That didn't sell well. Then they had the Wii, which everyone saw and used, and then we had the Wii U, which didn't do well, and then the Switch. And the Switch basically kind of introduced a new type of gaming to the industry, the handheld style for full-size games. Obviously, there were things like the Game Boy before this, but these were full regular games that you would then be able to also play on your TV. And so now there are competitors from, we have a portable from Sony now with their PlayStation Portal. We also have Windows-based competitors from the likes of Steam, as well as Asus and other PC companies. So this really did kind of set up a new kind of gaming. But for Nintendo, this is an absolute must. The console, as you can see, $449. That's a big price jump from the $300 of the original. If you get the game Mario Kart World with it, it's $499. So you save a little bit of money there if you could do that bundle. New Joy-Cons, they're now magnetic. They can also be used as a mouse. And then, yes, they have built-in chat, as well as new multiplayer features where you can set up a little camera. It's built into a PD Piranha plant, that piranha that eats Mario in the games, and you'd be able to communicate with other players. So they're going whole hog into the idea of being able to connect. That's obviously social part is a big part of gaming nowadays, and Nintendo really going into that. But this needs to be a huge success for them, and it's kind of a risk. Sticking to that same pattern, something they don't usually do.
Dan, we only got 30 seconds here. Were you at the Switch launch event in New York last night?
No, I wasn't, thankfully. I managed to avoid it. I do have, look, man, I don't even know why I'm talking to you guys. Target's supposed to be shipping mine today. I'm not getting any updates, so I need to know where it's at.
All right. I guess we won't tell anyone to go stand outside of your apartment and just wait for that shipment. We know that there's a lot of eager people trying to get their hands on those. Dan, good luck. Bring it in studio. Why not? Let's just put it up on one of the screens in here.
Start playing Mario Kart.
Exactly. Thanks so much, Dan. Appreciate it. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
That is your opening bell on Wall Street. You've got Circle with their IPO today from the New York Stock Exchange, and you're also looking at live images from the NASDAQ. But let's get you a check on the markets here. Taking a look at the major averages, you can see we've got green on our screen despite some of that worse than anticipated jobless claims data. More people filed for unemployment over the last week than economists surveyed had anticipated. You've also, though, got stocks rallying just a bit more off the back of that news that President Trump and Xi Jinping are having their phone call this morning, according to some reports about a potential trade deal. So we had a little bit of a bump up in stocks off the back of that. But as we have seen continue to be the case, the real movement that we're seeing lately in the markets in terms of policy reaction and economic data reaction is happening in treasuries and the U.S. dollar. Taking a look at yields moving to the downside this morning, especially here at the front end, or at the long end of the curve rather. You've got your 30-year yield moving to the downside as well. But finally, I want to pull up the U.S. dollar because my sources have continued to tell me that this is what is going to cap the upside levels that we have available for U.S. stocks here. Just want to take a look at how the U.S. dollar is performing year to date, down nearly 10%. So yes, the S&P 500 is up on the year, but you've still got huge dollar declines, which could continue to weigh on U.S. stocks. Brad?
Time now for today's strategy session. U.S. stock futures searching for direction ahead of the May payrolls report Friday, and any updates on the U.S.-China trade relations. But what do the technical indicators signal for stocks? Joining us now, we've got Sam Stovall, CFRA Research Chief Investment Strategist. Great to have you here with us this morning, Sam, just after the open. Let's just start there. What are the technicals telling us for right now from what you've been able to read through?
Well, good morning, Brad. Basically, it seems as if the all-time high set on February 19th is sort of serving as a tractor beam for those Trekkies out there, dragging, in a sense, the market up toward it and causing this correction of 19% to be concluded. So recovering all that we lost in a fairly short period of time. Historically, it takes us about 4 months to get back to break even after reaching a bottom. But in this case, it's going to end up being half of that amount of time. So I would tend to say that even though we have an awful lot of uncertainty relating to tariffs, relating to trade negotiations, et cetera, the market seems to be ignoring it like a ping pong ball dropping on a table. The first reaction was the greatest, and every subsequent one has been more muted.
Is the market right to be doing that, or is there a potential for investors to be caught off sides, especially heading into their summer vacations? Can they trust that the worst is behind them?
Well, historically, June is a fairly unimpressive month. It's in the bottom third in terms of average price change, significantly underperforming the average return for the S&P 500 itself during all months. Also, essentially, the volatility is fairly mild. But yeah, I would tend to say that since this is a manufactured correction, the one who's holding all the cards is the president. And should he decide not to make some agreements with China or to initiate new obstacles in terms of trade with our other partners, et cetera, that could end up upsetting the apple cart, if you will, especially if we end up having problems with rare earth minerals being imported to the U.S. to help out our automobile industry and other areas.
I'm hesitant to say, but anytime we're speaking together, Sam. So I will say yes and taco, because that is now the consideration as well. If the president does come out and say, all right, well, we're stepping off of talking about any trade deals, we're going to ratchet the tariffs back up, then you have traders on the other side that are saying, well, he might chicken out, as the acronym goes.
Absolutely. And so I think that's the reason for the muted subsequent bounces in the market, is because they realize that he will put them out as negotiating tactics, only to then take them back by saying, okay, well, I'll give you a reprieve for 3 months to help negotiate things. So the old adage is that prices lead fundamentals. And we have seen the S&P 500 rise 20% since the April 8th low. And we're also finding that those groups that were beaten up the most are the ones that actually are recovering the quickest. Communication services, consumer discretionary, technology, those three sectors on an equal weighted basis are up 26% versus 20% for the market. And the worst 10 sub industries during the decline are now up 32%. So, again, history reminded us that you want to rotate from first to worst, and that ended up being a fairly profitable proposition.
How are you thinking about tech valuations in this environment?
Well, tech valuations trading at about 28 times forward estimates. Its 5-year growth rate is projected at 17.5%. So its PEG ratio is equal to that of the overall market. So I would tend to say that while people like to compare it with the 2000 tech bubble, we're nowhere near that. We're more than 50% cheaper than tech stocks were back then, mainly because tech stocks today have earnings, whereas they didn't back in the 2000 era.
Sam, while we have you here, in previous conversations, it would be hard to get this far along in the talk without talking about the Fed. And we've done just that. I'm taking a look at the CME Fed Watch right now. By the end of the year, it looks like we're pricing in 50 basis points of cuts here. It doesn't seem like, and especially in this conversation, given that they're not taking priority, it doesn't seem like they need to be aggressive at all in getting to that 50 basis points of cut. What's your read through based on the economic data that we've seen in the labor market this week?
Well, in terms of economic data, you've got your hard data, which is more backward looking, and your soft data, which is based more on surveys. And the hard data continues to say we don't really need to be cutting interest rates because the economy remains fairly healthy. Yes, we did have a weaker than expected ADP report yesterday, but ADP traditionally has a pretty low correlation to what is then announced 2 days later, and that we'll get tomorrow morning at 8:30. So our expectation is we actually see a little better than anticipated rise in jobs at about 135 versus the 125 that the street is looking for, which is still less than what we got last month, but a little better than what the street is looking for. That could be encouraging. But related to the Fed, I remind investors that wanting is more profitable than having, and that in the 12 months after the last rate hike and just before the first rate cut, the market was up an average of about 19%, whereas in the 12 months after the first rate cut, the market was up less than 5% on average. So, I would tend to say that getting what we had been wishing for and hoping to have more cuts would be an implication that we need it because the economy is slowing.
Sam, great overview as always. Thank you so much. Appreciate it.
My pleasure. Thanks.
Let's get to the 3 market movers you need to watch for your trading day. Yahoo Finance's Jared Blickery has more. Hey, Jared.
Thank you, Maddie. First of all, we got the S&P 500 and the NASDAQ, both the composite and the 100, inching towards record highs within 2 to 3% of those, each of those. Also, I'm tracking bond yields. We're having yields drop nicely, and that is kind of putting a bid on stocks in the risk market. It is a relief valve. And then I'm also watching the commodities complex, in which silver is breaking out to fresh multi-year highs, decade highs, and we are seeing other metals follow. So let's dig into the S&P 500 on the Wi-Fi interactive behind me. You can see we are getting very close to the 6,000 level. Why is that important? Well, it's not really. It's just a big psychological level that people talk about. I like to look at the charts, and here is a 4-day price action. So we've just been bumping up against this 6,000 level, haven't been able to clear it. But here's the year to date for a little bit of a bigger picture, and you can see we are only, I think that's less than 3% off of those record highs now, up substantially off of those April lows. And I want to note some of the markets that are breaking to new highs here. I've been tracking tech, but guess what? Industrials just hit a new high yesterday. Tech is kind of like the indices. They still got a few percentage points to go, but industrials just barely squeaked out a new record and just looking very strong. In other words, the cyclical component of this rally has been one of its benefits here. And now let's, I do want to hit the chips before I go on too, because chips are looking very strong. The SOX index just jumped to a 3-month high. You can see a little bit of red on the board here. NVIDIA and Broadcom experiencing a down day today, but here's what's happened this week. You can see Broadcom up 7.6%, NVIDIA up about 5%, and some true leadership here from the tech sector. So now we're going to switch over to yields because I've been harping on the 30-year index, our 30-year bond yield, and that is now sinking quite quickly here. And let's see if I can pull this up, 4.87%. So it's down another 2 basis points today. We saw bonds surging yesterday, and that means that's actually good for yields because they move in opposite directions. So if you take a look, for instance, at the TLT ETF, which tracks the 20-plus year treasury bonds, this is a year to date, so it doesn't look that big so far, but here's the 2-day look, and you can see we had a nice surge yesterday. So that surge in bonds means yields are coming down, and you combine that with the sinking dollar, that is actually very positive. That is a reflation trade. Now, 2 months ago, a sinking dollar was a bad sign because yields were going up. That meant the world was selling bonds, but it is the opposite now. So the dollar and yields coming down together, that could be a good thing, but if the dollar drops too quickly, well, that could indicate some other problem. So everything is nuanced here. Going to move on to futures. I mentioned silver leading, and let's just take a look at this chart. This is the 2-day. Look at that jump right there. That is up almost 5% over these couple days. Here is a year-to-date chart, and you're going to see we finally broke out to new highs here. And I'll put a max chart on, which goes all the way back to the beginning of the century, and now we are testing 2011 highs. And this ultimate high up here, intraday, that was at the $50 level. So at 36.11, we still got some ways to go here, but that is within sights, and that's probably the next big target, $50 for silver. Imagine that. Gold futures also kind of following suit. This is since the beginning of the century. Let me just show you the 4-day chart here so we can see what's been happening recently. Chopping around a little bit, but getting closer to that $3,500, $3,600 price high, all-time high that we saw just a few months ago earlier in the year. And then I also want to track crude oil futures. Those popped above $65 a barrel. Now they are back down, and crude oil has been kind of stuck in a trading range as well. It might actually be good for the world demand picture to have crude oil. This is WTI breaking out, although it does mean higher gas prices. There's always good and bad with these things. And Brad, I'll send it back to you on that.
Jared, thanks so much. Teeing up today's trading session. Appreciate it. Coming up, stablecoin issuer Circle is set to begin trading on the New York Stock Exchange. More on what its debut means for the broader IPO market. That's next.
What is Circle and who's buying it? We're taking a closer look at the stablecoin issuer as it is set to begin trading. First, what is Circle? The crypto company issues stablecoins, which are a type of cryptocurrency that seeks to maintain stability by basing its value on an external factor. Circle stablecoin, USD coin, can be traded at a 1-to-1 ratio to US dollars. USD coin is the second largest stablecoin in the world. The IPO coming as stablecoin regulation is in front of Congress. If passed, guardrails could help further legitimize the industry. And Circle's IPO is getting attention from some huge investors. Kathy Wood's ARK Investment Management expressing interest in buying as much as $150 million worth of shares. That's according to an SEC filing. And per Bloomberg, BlackRock plans to acquire about 10% of Circle's IPO shares. Circle raised more than $1 billion in its debut after offering roughly 34 million shares on Wednesday.
Circle raised over $1 billion in its IPO, pricing shares well above its expected range, and a welcome sign of enthusiasm from Wall Street for the stablecoin issuer. Here to discuss what Circle and the debut signals for the IPO market more broadly, we've got Brianne Lynch, who is the Equities Zen head of Market Insight. Brianne, thanks so much for taking the time here this morning. Just the significance of Circle going public here and what is ultimately hopeful now to be a kind of major moment, or at least momentous occasion for the rest of the IPOs that are waiting for their right time to make a debut.
Sure. Thanks for having me. As you said, this has been a long-awaited IPO. Public market investors really haven't seen another crypto IPO since Coinbase back in 2021. So fast forward a few years, they're now an S&P 500 company. So if you look at that and having a crypto-friendly administration, the legislation you just talked about, that's in front of Congress, that would really regulate stablecoin and legitimize it, plus the fact that larger financial institutions are considering launching their own coins. These are all tailwinds and votes of confidence in the stablecoin market. So Circle is really looking to capitalize on that momentum in timing their IPO. And As a reminder, this is a company that tried to go public back in 2022 via a SPAC. So they probably had a lot of the pieces already in place. So, the right hires, the audits, the reporting. So they've really been able to move a bit more nimbly and strike while the market is hot.
And what does this signal to you just in terms of the IPO pipeline, specifically for names like Circle or any of the broader AI plays as well?
Sure. So we're definitely seeing more names enter the pipeline. You've got Omada Health going public tomorrow, Chime next week, and then Klarna, StubHub, Caris Life Sciences, several others that are in the pipeline. When you look over the past 40, 50 years, June has actually been one of the best months to IPO in terms of highest net proceeds and best first days of trading. So, some of these companies are maybe trying to capitalize on that. And this is a pretty narrow window as well before the summer comes and activity slows down. So companies could choose to wait to the fall, but we don't know what the market will look like in the fall, and there could be a lot more uncertainty. The VIX is at a bit of a more manageable level now, which is, prompting some of these companies to go public. But in the meantime, as we talk about these IPOs and companies that can come to the market, I think it's important to note that accredited investors can invest in these companies while they're still private. When you look at Circle specifically, hundreds of investors have invested in Circle on EquityZen's platform, as little as $5,000. So there are opportunities to invest earlier in the growth stories of these companies before they're 10, 15, 20-year-old companies going public.
What is the kind of profit profile that we're seeing of companies that are waiting in the wings to make their debuts relative to years past?
Sure. So we're certainly out of the growth at all costs era that you saw back in 2020, the WeWork era and whatnot. What we're seeing now is companies either need to be profitable, which is the case you see with Circle. They have about 152 million in net profit, or very close to profitability, narrowing losses quarter over quarter, year over year. So that is one very important factor. And then growth is also important. So the IPOs we've seen recently have exhibited at least 20% plus growth. And that's what investors are looking for. Yes, they want there to be growth, but they also don't want to invest in a company that may never be profitable. So that's kind of the balance. On top of that, companies really just need to have a strong narrative that resonates with the market. Certainly Circle is capitalizing on that right now, just with the boom of crypto and investor interest there. Even eToro, who went public a few weeks ago, is also able to, play into some of the crypto momentum. So those are some of the core components we're seeing.
And Brianne, just curious to get your take on the IPO market right now, a little bit more broadly, obviously coming out of kind of the SPAC era of the 2020-2022 range. There are several of those companies that have now become failures. But when I hear you describe the current pipeline, it sounds much more optimistic. Should investors be anticipating more of that success from IPOs to come in this particular environment?
Yeah. I think what we will see is strong companies choosing to IPO. Not any company that last raised in 2021, 2022 can go public. You'd have to have some of those key pieces that we just talked about. One thing that we have seen and will likely continue to see is what you would call a down round IPO. So companies going public at valuations below the valuation that they last raised capital at while they're private. Circle is a perfect example of this, looking at a $6.8 billion valuation when they last raised at a $7.7 billion valuation back in 2022. As more companies continue to do that, some of the taboo around that is going away, and encouraging other companies to follow. So that's another piece that we'll see. But certainly companies are doing a lot of work behind the scenes to get, the right narrative and the right financial picture in place.
Brianne, good to see you. Thanks so much for taking the time.
Thank you.
And make sure to check out Yahoo's private market data on our website to keep an eye out for the next big company that could hit public markets. Might be one that's in your home. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. President Trump is imposing travel bans and restrictions on 19 countries, citing national security risks. Here's what you need to know. Citizens from 12 countries, including Afghanistan, Haiti, Iran, Sudan, and Yemen, among others, will not be allowed into the United States. Additionally, travel to the U.S. by citizens from 7 countries, including Cuba, Sierra Leone, Venezuela, and others will be partially restricted. The proclamation does call for periodic reviews of the restrictions, and the president said the list is, quote, subject to revision based on whether material improvements are made, end quote.
Are there any exceptions to these rules? Yes. Some examples. The restrictions do not apply to lawful permanent U.S. residents, immediate family with certain immigrant visas, adoptions, special immigration visas for U.S. government employees, athletes, and coaches traveling for events like the World Cup or the Olympics. And case-by-case exceptions are also allowed. Why did President Trump create the ban? Well, according to the White House, the restrictions are the latest actions of a broader immigration crackdown. The president citing a recent attack in Boulder, Colorado, saying it underlined certain dangers posed by foreign nationals. Let's take a listen.
The recent terror attack in Boulder, Colorado, has underscored the extreme dangers posed to our country by the entry of foreign nationals who are not properly vetted, as well as those who come here as temporary visitors and overstay their visas. We don't want them.
Are these kinds of policies new for President Trump? No. President Trump imposed travel bans in his first term as president. After a back and forth with the Supreme Court, a ban on citizens from 7 nations, 5 Muslim countries, as well as North Korea and Venezuela, was upheld. This ban sparked protests and confusion across airports in the U.S. President Biden revoked those bans after taking office in 2021. Now, part of the consideration as well, even with the acknowledgement for the video that was played a moment ago here and the video that Trump had posted on social media, was that the person in that, the suspect and the terrorist that he was citing here, was actually not from any of those countries.
Correct.
In this list of the ban as well.
Correct, and I think it's incredibly important context for our viewers that this is likely to get a pushback from lawmakers across the country due to its lack of constitutionality. That's going to do it for the morning brief. You can join me in the next hour for more analysis on Catalyst. Stick around.